Okay, welcome back everyone to the Quant Investing Festival 2021. And wow, I must say that it is incredible how some of you guys have been with us since the very first day of the festival 2 weeks back. And it is now the third and final week of the festival. And no matter if you are joining us for the first time or you're joining us for the 8th time for these 8 sessions, here's a very warm welcome to you. And for those of us who might not know me yet, I'm Dawei from iFast Global Markets. Right? I'm an investment advisor for clients using the iFast platform, and I'm glad to be your host once again today. Right? And also to explain a little bit why we are organizing and running this festival throughout the years of investment advisory, actually my team and I, we have realized that the retail market has been very much underexposed to quantitative investment strategies that go beyond the usual 60-40 or 80-20 allocations, and also beyond the usual instruments of bond funds or dividend paying coupons that are supposed to pay us dividends. Okay, and therefore this virtual investment festival, we have been working together with our education partner AllQuant to come and share about these strategies with everyone. Right? And so far in the first week, we've talked about the background of hedge funds, right, on risk and return and what quant investing is, right. We've also talked a little bit about profiting in clarity. In the second week, we've covered on volatility by setting up the all-weather strategy and how running multiple strategies in a single portfolio called the multi-strat portfolio, it can actually boost our risk-return ratio for the better and also help to keep our returns very stable without compromising much on them at all, right? And so this week, we are here to talk about perpetual and recurrent income, which I'm sure a lot of us would be very keen on, right? Since most of us would likely want to have passive income in one way or another. Right? And yet today's topic on passive income is one that is very special. Right? We are going to talk about, right, not how income can be generated through the conventional way of relying mainly on dividends, insurance products, or bond coupon payments, right? But rather through the stability offered by a hedge fund strategy. Right? And before we start, just to mention once again, right, that at the end of every session in the festival, we are going to have a short quiz, right? If you are here for maybe the second, third, fourth, fifth time already, you would probably have taken one of our quizzes before. They are very simple. Every quiz only has 2 very simple questions. Right? And across the quizzes in this festival, every correct answer will give you an increasing chance to win the prizes for our lucky draw, right? Where we are giving away CapitaLand vouchers, right? And also all course packages from which you will be able to discover how to implement various hedge fund strategies on your own, right? Including things like risk parity, right? Trend following, the volatility risk premium strategy, and sector and country rotation strategies, right? So do pay attention today to let yourself have that maximum chance of winning the lucky draw. And so here with us today, we have Mr. Patrick Ling from AllQuant, who will be sharing with us on the topic of perpetual income from hedge fund strategies. Right? And following which, we'll also have Mr. Lim Ing to come in at the end during the Q&A section to help answer some of the questions that you guys might have on the topic today. Right? So for now, let me pass on the time over to Patrick. Patrick, before you begin, could you please introduce yourself first for the benefit of those with us here for the first time? And please feel free to take over the screen sharing from your side as well once you are ready.
Sure, Dawei. Thank you very much. Okay, hello everyone. It's evening here in Singapore now. So for those who are tuning in locally, I hope you had a wonderful dinner. Now, for those who have not yet had your dinner, like myself, not to worry. Today's session should be a relatively short one, so we can all still go for a nice dinner after this. All right. So like Dawei mentioned, for the benefit of those who are attending the festival for the first time, right? Let me start by introducing myself. Okay, my name is Patrick, and I'm one of the co-founders of AllQuant. The other co-founder is, of course, Ing. Okay, he'll be joining us later in the Q&A session. So before starting AllQuant, right, I've spent more than 15 years in the industry, starting out first as a portfolio manager in UBS Private Bank, where I helped to implement discretionary portfolio mandates for private clients. After a couple of years there, an opportunity came up to move to Hong Kong to work for an investment bank, covering hedge funds and institutional clients who wanted to trade equity derivative products like options and swaps. Eventually, I came back to Singapore to join Credit Suisse Product Control Department. My role there was to review rates and FX structured products that are traded by the bank. Ultimately, I ended up running money in prop trading, and eventually I became one of the portfolio managers in a quantitative hedge fund, implementing a multi-strategy portfolio together with Ling. All right, so through the course of my career, I've seen how financial markets have developed to the stage where investment strategies that were once the exclusive domain of professional investors can now also be implemented by individual investors. Okay, there are a number of enablers for this. First, product innovation has introduced a number of exchange-traded products that allow access to more asset classes other than stocks. And secondly, the internet has made information more broadly available to the general public. And last but not least, fintech has opened up new platforms that can help retail investors implement more advanced strategies. Okay, however, there's still one barrier remaining, and that is the knowledge gap. So that is the reason why Ling and I set up AllQuant to try and narrow that gap by sharing our knowledge on quantitative investing, which we believe is one of the most robust way of building an investment portfolio. All right. We also work with other people in the industry, such as iFast, to help individual investors who are interested in using quantitative approaches in their own portfolios. Okay, with that, let me move on to today's topic. Now, as I go through the presentation, right, feel free to type any questions you might have into the Q&A box. Okay, we will answer the questions later on, okay? So let me just share my screen now. Okay, so I believe that everybody can see my screen. Just give me a second while I... Okay, so throughout this festival, we have spent quite a considerable amount of time talking about ways to build a resilient investment portfolio that can weather through harsh market conditions, right? But why is it even important to have a resilient investment portfolio in the first place? So to answer that, we are going to look at a practical application of using the multi-strategy approach that we have shared so much during the festival. Okay, today's topic should be close to everyone's heart, even if it might not be a priority for you at the moment, especially if you're young. However, do keep an open mind, as you'll realize that the earlier you start, the easier it is going to be for you in your later years. Okay, so the topic is about using a portion of earned income from active working to build a retirement portfolio that can generate a steady stream of passive income during your retirement years. Okay, in fact, I'm talking about a perpetual income stream that never runs dry, and it is also something that you can pass on to the next generation. Okay, first, let's take a look at some common obstacles to retirement. A very common refrain we hear from people who should really be retired at their age, but then are still working, is that they have insufficient savings. All right, this is actually quite a common problem living in an expensive city like Singapore. So most of the time, right, our earned income easily disappears every month if we are not careful with our budgeting. And sometimes this problem also afflicts the high income group if one gets used to an expensive lifestyle, which then needs to be sustained going into retirement. Inflation is an insidious phenomenon that slowly but surely erodes the purchasing power of our savings. What we thought was sufficient 10 years ago, right, might not be sufficient today. And even if we are diligently setting aside part of our earned income every month for investment, a severe market crisis might happen just when we are about to retire. All right, and the crisis drastically cuts the value of our investment portfolio that we have painstakingly built up over the years. This would really upset our retirement plans and result in having to delay retirement for a few years. All right, and this is the best case scenario. In the worst case scenario, we are forced to retire And then we have no choice but to cut back drastically on our lifestyle, or even have to take on jobs that we would otherwise not want to. So it is for tackling these worries, right, that financial institution came up with annuity products. So what exactly is an annuity? Okay, generally, there are two broad types of annuities available in the market. The first type is what we call term annuity, and the second type is life annuity. So term annuities, right, they have a fixed period of payouts, whereas life annuities pay till the end of life. Okay, obviously the trade-off here is that life annuities typically have a lower monthly payout compared to term annuities. So for the purpose of today's session, let me use a diagram to explain how a typical term annuity plan works. So it is usually broken up into 3 stages. Okay, in the first stage, you are required to contribute a fixed amount on a regular basis into the plan. In this example, you are required to pay $12,350 every year for the first 10 years. Okay, so this plan then accumulates steadily and grows over time. Okay, the money that you put in is not idling, okay? It is put into the plan and then invested on your behalf by the investment manager that is tied to the plan. Okay, it usually goes into a mix of stocks and bonds, depending on the manager of the plan. Okay, so depending on the investment performance, right, the plan will grow at different rates. Usually the plan will come with a guaranteed growth path, which is represented by the blue line. So this is the minimum amount that is guaranteed by the manager of the plan. Then there is a higher projected growth path, which is the orange line. Now, the orange line is only a projection and shouldn't be relied upon for planning purposes. Okay, so at the end of 10 years, right, your plan would have grown to at least the final value of the blue line from a combination of your regular contribution as well as the guaranteed return. So then moving on to the second stage, right, you no longer need to contribute to the plan, and whatever is there in the plan at the end of the first stage, right, will then just simply continue to grow at the guaranteed rate or higher if the underlying investment can do better. So both the blue and orange line go up, but at a slower rate as compared to the first stage, right? So because there is no more cash injection coming in, right? So collectively, both the first and the second stage, right, belong to this thing called the accumulation phase of the plan, okay, because you're really just accumulating until the time where you start to draw down from the plan, okay? So finally, in the last stage, right, you will start to receive a fixed amount on a regular basis from the plan. Okay, again, the amount depends on the investment performance of the manager. So in this example, you will receive the minimum guaranteed amount of $12,000 up to the projected amount of about $17,600 every year. So this final stage is what is known as the distribution phase. Okay, so there is actually a fixed period for the payout, after which the plan terminates and you get nothing back, all right? So in this example, the payout lasts only 20 years. So you can imagine that this presents a longevity risk, right, for the buyer of the plan if he were to outlive the annuity plan, okay? So this leads us to the idea of a perpetual annuity, all right? So basically, a perpetual annuity, right, is the same as a typical annuity, except that the payout doesn't stop, all right, as represented by the dashed lines, okay? The regular distribution does not deplete the underlying portfolio that is supporting the payout. So in other words, right, it is like having an immortal chicken that lays golden eggs forever. So you may be wondering, so how is this possible, right? It sounds too good to be true. So this is where we need to understand the key factors that determines the performance of an annuity, all right? The first factor is the annualized return that can be generated by the underlying investment. Okay, we have already seen this from the difference between the blue and orange lines. So the orange line is able to grow to a bigger pot at the end of the accumulation phase, simply because the higher annualized return of 4.38% allows the amount that you put in, right, to grow at a fastest rate compared to the lower guaranteed return of 2.73%. Okay, so this first factor should be relatively straightforward and clear. But it is the second factor that is often overlooked, right, by people, and that is how much can the underlying portfolio lose from peak to trough, or what is the maximum drawdown that can be experienced by the underlying portfolio based on history, all right? If the maximum drawdown were to happen close to the end of the accumulation phase, right, the portfolio value can be reduced significantly, as shown by the dashed red line, right? This would lead to implications during the distribution phase, whereby the money can run out prematurely. Okay, so if we want a secure annuity plan, right, we need to make sure that the underlying portfolio not only can deliver a decent annualized return, but it must also be able to do so in a consistent, stable manner that doesn't suffer from a severe drawdown for whatever reason. All right. So this is the MSCI World Index since inception in 1969. MSCI World is a broad index covering most of the developed markets in the world, so it is a good proxy for global stock market performance. So at first glance, right, it looks like the global stock market is a good investment to build an annuity plan because it went up over the long term. But let's take a closer look. The annualized return since inception is about 9%. Now, this is a decently high return, so it fulfills the first key factor, all right? However, notice that there are significant drawdowns along the way. One such episode happened when the tech bubble burst at the turn of the century. Another major drawdown happened during the Great Financial Crisis in 2008. And then, of course, the most recent event that is still fresh in our mind is when COVID-19 first erupted across the world in March last year. So in fact, the MSCI World Index, right, suffered significant drawdowns before, and not just once, but a few times. Hence, we can expect such drawdowns to happen again going forward. Now, if we are immortals, right, we do not need to bother with drawdowns because markets eventually recover and proceed to make new highs. Unfortunately, all of us have a limited lifespan. And more importantly, all of us have a fixed period of time for us to build our retirement funds. So let's use 20 years as an illustration. If you're born earlier, right, your 20 years will start earlier, say in 1970, and ending in 1990. Then someone who is born later might have his window starting in 1980 and ending in 2000. So we can really only rely on 20-year sample of the MSCI World Index, right, to see if we can really achieve the 9% annualized return as advertised. Okay, we can easily do a simulation by using a rolling 20-year window period, starting at the beginning of 1970 and ending at the beginning of 2000, to see what the ending portfolio value is for different people starting in different years. All right. So for this exercise, I'm using the same parameters as our annuity example earlier. So $12,350 is invested at the start of every year for the first 10 years, and then the portfolio is allowed to grow for another 10 years. So if we assume a steady 9% return every year, the portfolio should grow to $482,000 at the end of 20 years. So this is the target portfolio value for someone who is using the global stock markets to build his annuity. So if the underlying investment is stable, right, it really should not matter when a person starts to build his annuity. Everyone should expect to have $482,000 at the end of 20 years, whether he started in 1970 or in 2000 or anywhere in between, all right? However, in reality, right, people who were born earlier did a lot better than people who were born later. So those who started before 1982 exceeded the target by a wide margin, while those who started after 1988, right, they ended with a portfolio value that is significantly below the target. So this is what we call shortfall risk. So ask yourself, do you really want to subject yourself to such a lottery of when you're born? So therefore, we can conclude that the MSCI World Index fails in this second key factor of investment stability. Okay. Now, in contrast, this is the long-term performance of the multi-strategy model that we have shared numerous times throughout this festival. Okay, the annualized return is about 12%, and the maximum drawdown over this entire period is also about 12%. Note that this period covers two major stock market crises. The first is the Great Financial Crisis in 2008. The second is the more recent COVID-19 crisis in March last year. Now, COVID-19 was a significant test for our multi-strategy portfolio because a global pandemic did not exist in the backtest period for the models. Okay, regardless of this, our multi-strategy portfolio, right, not only survived, but thrived through COVID. So it looks like the multi-strategy portfolio fulfills the two key criteria for building an annuity, right? So let me recap. The first one is having a decently high annualized return. And then more importantly, right, the second key factor is to have a stable return, okay, that doesn't really suffer badly during a harsh market condition, okay? So now let's see what we can get if we use the multi-strategy portfolio to build an annuity with the same parameters as the typical annuity plan that we've seen earlier. So we also invest $12,350 every year into the multi-strategy portfolio for the first 10 years. Then we do nothing for the next 10 years and just watch it grow. Now, the portfolio seems to grow a lot faster in the second stage compared to the first stage, even though there is no cash inflow. Okay, this is where the power of compounding at a high return comes in. We started from a low base in the first stage. By the end of the first stage, the portfolio has grown to a more substantial size. It is then able to compound exponentially in the second stage, ultimately ending in a portfolio size that is multiple times the size at the start of the second stage. And it is because of this sizable portfolio at the start of the distribution phase that the portfolio is able to support a high payout of $70,000 annually, all right, without ever depleting the portfolio. Okay, note that the portfolio is still being invested in the multi-strategy model, which is why the portfolio can replenish itself despite the regular distribution, okay? So in summary, we would have invested a total amount of $123,500 over 10 years to be able to support an annual distribution of $70,000 into perpetuity, all right? Now, if one can afford to front load the investment, we can benefit from compounding at a decently high return right from the beginning. So in this front load example, we invest $100,000 at the very beginning, at the start. After compounding for 20 years, the ending portfolio value, right, will be higher than the earlier example. Okay, so therefore, this portfolio can support a higher distribution of $95,000 every year into perpetuity. Okay, so this highlights an important point here. If we are able to build a consistent return stream, right, that grows the portfolio steadily over time, we are better off investing in a lump sum approach right at the start rather than spreading it out. And this is because spreading out the investment, right, would mean that we are losing out on the earlier compounding effect for the later cash inflows. All right. So this is just a summary table comparing the three different annuity examples presented today. In terms of total contribution, the front-loaded multi-strategy approach requires the least amount of contribution, although the entire amount is needed upfront. In terms of projected annual distribution, the multi-strategy approach beats the typical annuity plan by a wide margin, whether is it front-loaded or not. And finally, the multi-strategy approach is able to distribute perpetual income without ever depleting the underlying portfolio, whereas the typical term annuity depletes the underlying portfolio and has a limited distribution period. All right, and even the typical life annuity that distributes till the end of life does not come close to the multi-strategy approach because distribution can only last till the end of life and there is nothing left to pass down to loved ones. Okay, so the reason why the multi-strategy approach is able to deliver a perpetual income stream really boils down to being able to fulfill the two key factors, namely a sufficiently high investment return and the ability of the investment portfolio to weather harsh market conditions. All right. Okay, so we have come to the end of today's presentation. So the multi-strategy approach that we have shared throughout this festival can be implemented by individual investors through the use of publicly traded ETFs that is available in the market. In fact, Dawei have already been implementing it for some of his clients through the iFast Global Markets platform. So if you're also interested in getting Dawei to help you, you can just scan this QR code, which will lead you to our website. Just fill in a simple form and Dawei will be in touch to get the conversation started. All right, if you want to reach out to either Ingwan or myself, you can also contact us separately. Our contact details can also be found in the website. Okay, so I'll hand over to Dawei now to administer today's lucky draw quiz questions. There will just be two simple multiple choice questions that's related to today's topic. You should be able to finish each question in under a minute. But in the meantime, if you have any questions regarding today's topic, do type them in the Q&A box. Ingwan and I will try and answer these questions after the quiz. Okay, so good luck, and I'll talk to you in a short while.
Okay, thanks, Patrick, for your sharing today. I think it is really very good and very wonderful for us to be able to hear about an alternative way to get our recurrent passive income, especially for retirement. I think a lot of times people, when we are talking about recurrent income, right, some of us might have zero and no clue at all. How do we get any passive income? Right? Some of us might be familiar with a few ways, right? One of the ways which would include rental income, right? So a lot of times there is this ongoing idea that we need to buy a lot of properties in order for us to have rental income and enough passive income for us to sustain our retirement, which is really not true at all. Right? Rental income is one of the ways in which we can get that passive income, but it is not the only way. Right? In fact, there are a lot of strategies in investments that we can do for us to be able to create that passive income which we will want during our retirement. Right? Some of us, we might be familiar with using our pension in Singapore. For every Singapore citizen and permanent resident, right, we do have the CPF for us, right? And some of us, we might be familiar also in using instruments, for example, right, insurance products, right, saving plans, right, endowment plans, insurance annuity products, right? Some of us might be familiar with some of these, right? But beyond that, right, there are still a lot of ways to achieve that recurrent passive income, right? And investing is one of them, right? Maybe we were used to using bonds, right? We know how to use bonds and use bond funds for us to diversify our investment portfolio to create that recurrent income. But other than that, right, we also have to deal with that possibility of having our capital dropped, right, very close to the time before we want to start that recurrent income process, right? And that's why today's sharing, right, on this passive income through hedge fund strategies, where we have that ongoing protection or ongoing stability, right, to be more exact, stability in our investments, would really, really help us and be of very much value to us, right, in the many years ahead. Okay, so let's proceed on to the quiz, right? And let me just bring on the quiz for everyone to see. Okay, so as usual, right, to join the quiz, feel free to use your mobile phones and scan the QR code, right? And you'll be able to enter straight into the quiz. Right? If not, you can also use the URL on the top of the screen, which writes ahaslides.com/G5USS. And I'm going to remove the QR code in a moment, right, so that we can proceed on to starting the quiz. But just in case some of us still have not been able to join, right, that link at the top of the screen, it will still be there for the whole duration of this quiz. Okay, let's have a little bit of time for everyone to join in. Thank you for all the hearts and all the thumbs ups. I really appreciate it. And always glad to see everyone enjoying the quiz sessions that we have. Okay, I'm going to remove the QR code soon, right? Maybe another 10 seconds or more. Right, please scan the QR code. You can use your handphone, right? Mobile phone, right? Go to your camera and just place your camera on this QR code over here. Okay, let's start. Okay. So as mentioned, right, there are 2 MCQ questions for every quiz. And for each question, you'll have 60 seconds to answer that. Okay. Okay, so to identify and register everyone for the lucky draw, if you get at least 1 correct answer, right, please also provide the last four characters of your NRIC or your passport number if you're not from Singapore, and also your name as well as your email address. So let's give everyone some time to key all your details in. Okay, so let's proceed. Please remember to press join on your mobile. I see some familiar names over here. I see Paul, I see Katie, I've spoken to some of you guys before. I see Soma. Soma, thank you for coming to join us, right? Okay, so I'm going to start. Okay, first question. What are the common features of a typical term annuity product? Okay, so a lot of times we hear about annuities. Annuities, they are products that can give us certain recurrent income, right? And they're structured in certain ways. So how is a typical term annuity product structured? Right, please look at your phones, right? What A, B, C, and D are, they are written on your phones. Okay, 10 seconds remaining. Okay, so the answer is B and C, right? And what B and C are is you invest a fixed amount at regular intervals for a fixed number of years. This is also called the accumulation period. And C says that it pays a regular fixed amount only for a limited number of years. And that's exactly what term annuity is about, right? In general, the definitions for what an annuity is, right, there are a little bit of different views over what an annuity really is. But over time, to make things very clear, the term annuity has come out to really be clear and explicit that a term annuity will only pay for a fixed number of years. It's not a term annuity, but it can be a general annuity which will pay for the rest of our lives. Okay, a term means it only lasts for a fixed period. Okay, so let's move on to the next question. Second question. What are the two most important factors for portfolio underpinning an annuity product? So this is very crucial and very important for any of us who want to run our investments that are designed to eventually pay us a passive income. Is it highest historical annual return, or is it a lowest tracking error with benchmark, right? This is something that we see a lot of times in ETFs, right? A lot of exchange traded funds. We are always looking out for a low tracking error so that it can really accurately follow the underlying benchmarks, right? And C says decent risk-adjusted annualized return, right? And it can also possibly be low historical peak to trough loss, right? So which are the answers? About 5 seconds left for all of us. Okay, time's up. Okay, we have a variety of answers. The answer is C and D, right? So what C says is decent risk-adjusted annualized return, which is extremely important because after all, if we are starting on a journey to accumulate a certain investment sum so that eventually we have a good passive income amount, then it is definitely very important for us to have a decent annualized return during the accumulation phase. And for D, definitely that low historical peak to trough loss is very important, right? Because if your investment portfolio and your investment process is going to have a very large drop, possible drop in value, then it's actually no different from a usual traditional investment. And at the same time, it also does not give that assurance or that higher level of security for us to transit into that payout phase eventually when we want that recurrent income. Okay, and also just to mention, tracking error is something that ETFs are a lot of times looking out for, right? Because in terms of trading products in that short duration, things can be very sensitive. And when ETFs are around, they are meant to track and replicate certain benchmark indices, right? And this is what we call going for a low tracking error. Like if a tracking error is very high, then essentially your ETF might not be very, very attractive, right? Because there may be a lot of errors and a lot of missed model returns that we are supposed to achieve that we can't if we use these ETFs with high tracking error, right? In a context of the investment portfolio for retirement or for passive income, right? This is definitely one of the considerations, but it is not any of the biggest considerations that we will want to have in the back of our mind. Okay, so thank you for participating. Right? And if you are the winner of our lucky draw, right, we will be announcing you as the winner this Saturday, which is our last day of our festival. Okay. So it's time now for the Q&A. Right? Let me just bring back on the quiz. Right? If any of you guys have any questions, right, please feel free to type them in the Zoom Q&A section below. Right? And we'll do our best to try to answer all the questions by the end of this session. Okay, hold on, let me bring up the screen. Okay, we have a question from an anonymous attendee, right? Will there be a point in time where the strategy fails to deliver, right? So by failing to deliver, it can mean a few things. I would guess that it is either failing to deliver the stability for our portfolios and also failing to deliver that required recurrent income, passive income that we are targeting for. Okay, so for this question, maybe Patrick or Ingwen, you guys might want to come in and answer.
Okay, I think I can take this question. Okay, I think it's a very good question. And actually, it's not the first time that we've been asked this question before. Okay, as with all strategies, not necessarily just our strategies, but any strategies out there that is available out there within the industry. Okay, there is actually no clear way for anyone to actually know whether the strategy is actually breaking down or not, or will it ever kind of break down in the future itself. So there's often a dilemma that professionals also face. So you got a very good working strategy, then you've been running it and making good money for a while. Then after that, something seems to go wrong, right? And you always come to question yourself, say, does this strategy stop to work? Or is it failing at this moment? What if I take the strategy out and suddenly the strategy comes back to life and it starts working again? Or if I don't do anything about it, is the strategy continue to going to bleed and keep on losing money, right? So these are fundamental questions that professionals always ask themselves day in, day out. So there will be never a clear answer as to whether the strategy has breakdown or not at any particular point in time. The best that you can do is to fall back on what you know and the previous data and models that you built. That's why we do a lot of modeling, a lot of back testing, and through our own experience as well, then you can look at the model or the strategy. And then you can analyze for yourself both qualitatively and quantitatively. So for example, you might take a look at it and see, is the model behaving out of norms, right, with what it used to behave? Is it out of expectations? Under the circumstances, do you expect your strategy to perform or underperform, right? So if it is nothing out of the norm, then there may be no cause for concern, right? Then there are other things that you can also fall back on. For example, the maximum drawdown, which we have talked about during the webinars before. So losses will always be there, no matter what strategy you run, because there's no such thing as a all invincible, unbeatable strategy that just keep on generating return for you every single day, every kind of situation out there. So you will experience losses, but the key thing is whether these losses, are they also out of the norms? Have you experienced that kind of losses before, right? So if we have done our back test, we've done our modeling, so we have critical information or insights about all these things, like in a bad scenario, how much can the model lose? And how long can the drawdown last? Does it take like 3 months to recover, 6 months to recover, or a year to recover? So all these things you will have at your fingertips, and this is something that you can fall back on. So if let's say some of these criteria or conditions are breached, then you can ask yourself, okay, maybe it's a time for you to decide whether or not you want to retire that model out of your entire strategies itself. Okay. So these are questions you will face definitely. I mean, as professionals, we have faced it more than once. So it's something that is not new to us. And that is also one very key reason why you should not just run one single strategy. And that's why we run multiple different strategies together. They're uncorrelated with each other. So that if any one time, one strategy breaks down, you have a whole suite of other strategies that keep supporting your entire portfolio onwards. And at the same time, you'll keep on kind of reviewing the markets, doing research, and generate new ideas and concepts along the way where you can actually add on to the entire portfolio to make it even more robust along the way, right? So that's how you keep this thing churning and going on. Yep, I hope this kind of addresses your question. Okay.
Yeah, maybe I'll just add on a little bit. So generally in the quant world, right, there are broadly two, I would say two school of thinking, right? The first one is that they always start off with kind of like a fundamental idea of why a certain quantitative strategy might work. So yes, we base on some fundamental principles before they actually go and do all the back testing and getting all the data that's required to kind of prove the hypothesis, right? Now, another school of thought is that these guys, they don't care about the fundamental reasoning. Okay? They just say that, okay, I'm going to pull data, right, from whatever sources I can get hold of. And then I try and force feed it into a model. And then if the model output shows that it works, then I'm going to use it and run it going forward. So for Ingwan and myself, right, we are not going to say whether the second approach is going to work or not. But personally for us, right, we prefer the first approach, which means that we start off with a hypothesis of why we think that there is alpha in a certain strategy, a certain type of strategy. And then that's when we go out, get the data that we need, pump it into our models, and see whether it proves our hypothesis or not. Okay, so doing it this way, right, has an advantage because when things turn badly for that particular model, right, or the strategy, right, then we can then go back to the market and see what might have caused the model to perform badly. And if that particular reason, right, is something that we already know about, because based on our backtesting and our hypothesis of why the model works the way it does, right, then at least we have a greater sense of I would say confidence to say that this model hasn't broken down, right? So there is two things. First is quantitative parameters that we observe based on historical backtest. And the second one is the qualitative factors, which again comes from the fact that before we actually run the model, we already have a hypothesis. We already know intimately how the model works, what drives it, what kind of market condition is good for it, what is not so good for it. And that's why we have the confidence to run the models going forward. Okay, and as Ingwan mentioned, right, despite all this, we still don't want to be complacent and just run one single model. We want to run multiple models so that even in the event that one of the models is going through a tough time, we actually have more ample room to allow it to just basically bear it out, so that once the tough time is past, right, then this model will start to perform again. Now, obviously, as it goes through the tough time, right, we have to ask ourselves the question, right, is the fundamental hypothesis that we built the model, is it broken? Okay, do we think that something has changed fundamentally that this model shouldn't work again going forward? Then If that's the case, right, then obviously we will not hesitate to take out a model. And that is all right, because it is only one of the many models that we're running. So taking it out, right, will not impact the overall multi-strategy portfolio. It can still continue to run. Okay.
Okay, thanks, Evan and Patrick, for sharing. Definitely very important for us to hear how that multi-strategy approach is so crucial for us to always diversify away the risk, right? And especially the risk that just in case the fundamental reasoning or basis of any of our models are actually a little bit shaky. Okay, so let's move on to the next question. Right. Okay, so I see a very important question again from an anonymous attendee. Right. Where does the annual distribution money come from?
Okay, maybe I'll take this question. So the way the multi-strategy is being implemented, right, is that basically every month there will be a rebalancing of the overall portfolio. So at the point of rebalancing, right, what we can do, if let's say we want to basically take out a certain amount of money every month from the portfolio, what we can do is when we do our rebalancing, right, instead of rebalancing to the value that is at the end of the month, what we can do is that we take out the amount that we want to withdraw from the portfolio, and then we rebalance the portfolio to that new value. So let's say, for example, at the end of the month, right, the portfolio is say maybe at, let's say 1 million. And then we have a withdrawal, we actually set a withdrawal rate of, say every month we want to take out $10,000. So when it comes time to rebalance at the end of the month, right, instead of rebalancing it to 1 million, you rebalance it to 990,000. Okay, so then you will be freeing up $10,000 as cash, which you can then withdraw out as your living expenses or whatever, as your passive income. So whatever dividends that comes in from your securities, right, they will just basically go back into the portfolio as cash. Okay, and then it's either reinvested or it's taken out as part of that the cash amount that you want to withdraw every month. Yeah, so I hope this explains how the positive cash flow comes about.
Thanks, Patrick. Right, let's move on to another question. Right, so this question is asking, can we do monthly distributions instead of annual distributions? If you guys want to share with everyone here, what are some of the considerations when we are trying to do a distribution that is more frequent, like monthly, instead of maybe semi-annually, quarterly, semi-annually, or annually?
Okay, maybe I can try to answer that. Okay, you can do monthly distributions, you can do annual distribution, quarterly, semi-annual. The discretion is actually kind of up to you. Okay, but you need to be mindful that when you do a monthly distribution, that means you are kind of drawing down on your portfolio earlier. Okay, versus let's say drawing down 1 year later. So that will kind of also have a little bit of impact, right, on the amount that you can actually draw on. But because the portfolio itself is fairly stable, okay, unlike in a case where let's say you have, if you let's say fully invested purely in equities and using that as the means, right, for your retirement portfolio, and you're trying to draw down on that. So with those type of pure equity portfolio, it's going to be a lot more volatile, right? And when you meet a case of, let's say, where you're undergoing a severe bear market or crisis, where the portfolio actually crashes down, and you're trying to draw down on it every single month, and that's going to kind of like make the portfolio harder to recover, right? But with the multi-strategy portfolio, which is a lot more stable, and this presents a lot less challenge. Okay, so I think the discretion is up to you whether you want to do it monthly. It's possible you want to do it semi-annually. It's possible you want to do annual distribution. That can also be done. Okay, so the flexibility is there.
Yeah, and just on this point, right? In fact, we have started kind of like a fictional retirement story or journey of 3 fictional characters. They all have their own personal background. So one is, I mean, you know, from young to old, and they are all implementing this so-called building their retirement portfolio, right? Using this multi-strategy approach. So this scenario is on a monthly basis. So they want to be able to withdraw their passive income on a monthly basis. And also at the same time, they are building up their retirement portfolio also on a monthly injection basis. So, I mean, in case you guys are interested, right, you can follow along this, this journey, because this journey, right, is not back-tested. It's based on going forward. So whatever the models that we are running now, these guys are also using it on a real-time basis. So you can actually see, right, in real time, whether these guys, how are they on track with their retirement plans.
Thanks, Ingwen and Patrick again. So I do see one last question, right, which is asking on how simple or complicated is it to derive the drawdown trades to run the multi-strategy portfolio. Okay, maybe let me come in and share on this. Right. So for those of us who might be keen to run on the multi-strategy portfolio, right, we do need to know and understand that currently the multi-strategy portfolio, it has at least based on the models from Ingwen and Patrick, it has 31 possible ETF positions. Right? So there are 31 possible ETFs, and currently we are having, if I remember correctly, 15 of those positions that are currently having live allocations into them. Right? So when it comes to running the multi-strategy portfolio and trying to draw down on those trades, right, especially if you are trying to do it monthly or quarterly, right, there are a lot of factors to consider. Right? How do we draw down and rebalance at the same time? Right? How do we make the cost efficient? Right? Which ETF positions do we draw down? Right? And very importantly, right, we have to avoid that error in any of our portfolio decisions, right? And so there are times, right, where we have seen, right, certain clients or certain investors, right, trying to run their portfolio and trying to draw down on their portfolio, right? And sometimes there is one or two errors, right, being made, right? And when there are one or two errors being made, there are times when it is simple to rectify. There are times when it is really very difficult to rectify, right? Especially when volatility is spiking. Right? And so this is the situation out there for actually a lot of retail investors, right? If you are very sure and very confident to run your own strategy, definitely we encourage you, right? Please grow your wealth and draw wisely from your wealth. But if not, we are always available and are happy to help you guys, right? In case you guys find that you would prefer to have your investments run by a professional instead. Okay, so yes, we don't have any more questions for now, right? So we are also just a few minutes off our cutoff time. So in that case, just thank you everyone for joining us today. Right? In our next session, we are going to talk once again, right, about recurring income, but this recurring income is going to be of a slightly different context, right? It's going to be of the context whereby private trust funds or certain church funds, right, it's time where people start to understand and start to also realize actually how are some of these very large or a little bit larger funds, right, running some of their recurring incomes, right? How do they protect and protect their wealth, protect their capital, right? And how do they really wisely manage all these in terms of certain personal preferences or ideas that are supposed to be there for these organizations. Okay, so do sign up for the session on the 30th if you haven't. Right, we will be having our iFast World Markets Investment Director, Mr. Bernard Chan, come in to share with everyone on how he runs these funds. Right. And this Saturday, we will be announcing our lucky draw winners as well. So please come and join us as well, and we will be very happy to give you that warm celebration if you win the lucky draw. Okay, so that's all for today. Right, thank you everyone. Right, if you do have any more questions, feel free to just contact us either through the QR code, or you can look for AllQuant's contact as well, right? Or you can look for my contact as well when you are signing up through the rest of the sessions for this festival. Okay, so that's all for today. Thank you and have a good week ahead.
Yep, thank you. See you. Bye-bye.
Bye.